A lot of people assume that inflation is a newer concept. But let's take a look at how money has changed, because money today is not what it was 10, 20, 30, 40, or 50 years ago. Between 1971 to 2021, household income in America has grown by around 600%, which sounds good. But we got to compare that to the price growth of things. Between 1971 to 2021, the prices of cars, new cars, have grown by around 850%. The cost of a home, a house, has grown by around 1,200 some percent. The cost of the average college tuition has grown by around 2,000%. So if household income has grown by 600%, that might look good when you look at it in isolation, but when you compare it to the price growth of things that you need, it hasn't kept up. Not to mention that between 1971 and 2021, we went from one-income households to two-income households. In 1971, the average household was a one-income household. The man went to work and the woman didn't. That's what it was in the early 1970s. Today, that's not what it is. So we have one-income households go to two-income households. But even despite that growth in household income, it hasn't kept up with the price growth of things. Now you have to wonder, what's going to happen over the next 10, 20, 30, 40, or 50 years? Are we going to have four-income households? Because inflation is not going away. The Federal Reserve Bank has said inflation is not going away. They said they want 2% inflation, not 0% inflation, 2% inflation. And why 2% inflation? Because 2% inflation is low enough for the average person not to notice it. So year over year, yeah, maybe you feel a little bit more of a pinch, but it's not anything significant. 2021, 2022, when we were seeing much higher 5, 6, 7, 8, 9% inflation, people noticed it day to day. That was a problem. 2% inflation, you don't notice it day to day, not so much of a problem. And this is where we have to understand our economic system is designed to benefit the investor. It is not designed to benefit the employee. Now, I want you to hear me when I say this very carefully. I'm not saying don't be an employee. I'm an employee. I'm an employee at Briefs Media. But what you have to do is also become an investor. And I'll explain what I mean by this. Our economy has three types of entities. You have consumers, we have businesses, and then we have investors. Every single person is a consumer. Rich people, middle class people, poor people are consumers. We all go to places to eat. We all buy groceries. We all buy clothes. We all buy cars. Everybody's a consumer. So consumers spend money at businesses. You go to Chipotle and you buy the extra guac. You're spending money at the business. But who does that benefit? That benefits the investor who owns the company, who owns Chipotle, who own the profits. Anybody can be a shareholder in Chipotle, but when you are an investor, you own those profits. What happens when inflation happens? Inflation means consumption becomes more expensive. You spend more dollars at the business. So when you see inflation, consumers spend more dollars at businesses, which means the investors control a larger share of those dollars because investors own those businesses. So this is what we saw happen over the last 5 years. The median household income over the last 5 years, between 2019 to 2024, has grown by around 20%. Housing costs have grown between 50 to 70% depending on who you ask. The S&P 500, the stock market, is up almost 100% or around 100% over the last 5 years. So you have some people, the investors, that have accumulated way more dollars, have become way wealthier. The people that are just relying on their salaries haven't. And this is why you need to convert your salary to investments. But there's one more part to this. Now, I am a licensed attorney, although I am not your attorney. But one of the things that I have spent a lot of time studying is the tax law. And what I can tell you is that our tax code is also designed to benefit the investor more than the consumer, more than the employee. What do I mean by that? When I get my paycheck, when I get my W-2 salary, I pay what's called ordinary income taxes, earned income taxes. That means you're paying the highest tax rates and getting the lowest tax breaks. But when I make money from my stock market investments, when I make money from my dividends, that's what's called long-term capital gains. They qualify for lower tax rates. When I make money from my real estate, I get bigger tax breaks. So when you are an investor, you benefit from the system because number one, money flows to the investor. Number two, inflation benefits the investor. And number three, the tax code benefits the investor. Our economic system is designed to benefit the investor, but our education system doesn't teach you to invest. It teaches you to be an employee, but it never teaches you how to invest. Nothing wrong with being an employee. And I want to hammer this home because I know a lot of people will say this, being an employee sucks. Go start your own business. Starting a business is hard, okay?
You're right.
It's not for everybody. And that's not what I'm trying to say. You got to understand that wealth is built through investments. And that investment can be anything, but you got to be an investor. And if our economic system is designed to benefit investors, how come we don't teach people how to invest? We live in a capitalist system. The people that become wealthy are the ones that understand how to put their capital to work in a capitalist system. It's not the people that make their money from their labor. And when you understand that, you're going to start using your money differently. And that's where the wealth is built. So when we talk about, these changes happen in the economy, yeah, it's a problem because we have a lot of debt. Most people don't understand how to use debt. Most people don't know how to use their money. Debt has become easier to access. People are using the debt to buy Gucci, to buy vacations, to buy a bunch of dumb things that don't make them any money because those corporations and banks hire the smartest MBAs in the world and pay them top dollar to get you to spend your money, and you never even see it coming. So that's where the issues lie.
Yeah, well, I love that you teach that, and that's, it's all true. I mean, it's if you want to get better and make more money, you have to have your money that you do have work for you, not just buy things with it and become a consumer. And I've said
people
that
say that if I made more money, my financial problems would be solved. The statistically, majority of Americans that make over $100,000 a year are broke, living paycheck to paycheck. More than 50% of Americans that make $100,000 a year plus are paycheck to paycheck.
Yeah, that's very true. What do you think about the commercial real estate industry overall right now?
So we have a wall of commercial real estate debt. I forget if it was Business Insider or Forbes or one of those that called it a tidal wave of commercial real estate debt. Something like 1.5 or 1.4 to 1.6 trillion dollars of commercial real estate debt that is going to begin readjusting in 2024 through 2026. Because commercial real estate debt is often not a 30-year fixed rate mortgage, which means it readjusts every 3, 5, 7, maybe 10 years, but generally the 3, 5, or 7 years. And so generally what would happen is if interest rates go up, you as a landlord have a higher cost and you pass this cost down to your tenants. But the problem is you have a lot of office buildings that are still 20, 40, maybe 50, maybe 60% vacant. And so when you have a building that's half vacant, that's not paying you rent, and now your debts are starting to come due, you have a double-sided problem. Number one, maybe you can kind of get by on your payments if you refinanced in 2020 when interest rates were at the lowest rates ever, or 2021. But if your costs are about to rise and you cannot now pass down these costs because you don't have anybody to pay those costs, now you have a problem. And that's that problem that a lot of people are just hoping will get brushed under the rug as the Federal Reserve Bank is now beginning the rate cutting cycle. And so every commercial landlord sitting on debt is begging the Fed to start cutting interest rates more aggressively, to be more aggressive with interest rate cuts so mortgage rates can fall, so that the commercial landlords can then refinance their debts at a lower rate. And it's not just commercial landlords, it's private equity firms, it's corporations sitting on large amounts of debt. I mean, anybody that has readjusting debt wants lower interest rates. Anybody sitting on cash wants higher interest rates because, number one, you get an actual return on your cash when you have higher interest rates. And when you have higher interest rates, the dumb investments start to fail. And then people with cash can come in and buy those dumb investments for a big discount because, well, when you make a lot of dumb investments that aren't making money and then the bank forecloses or takes that investment from you and they sell it for a discount, the person with cash can come in and buy it at a discount. So people with cash want higher interest rates. The people that are sitting on debts that are about to readjust want lower interest rates. What is the Federal Reserve Bank going to do? We don't know. But we know what they're keeping their eye on. They're keeping their eye on, number one, inflation. And number two, they're keeping their eye on the economy/job market. So what the Fed says is we have a dual mandate, that we want price stability and we want maximum employment. That's what they say. That's what their mandate says. What that means in simple English is, number one, they want stable inflation, 2% inflation, and they want lower unemployment. Well, what we're seeing from the most recent data, the most recent inflation data came in a little bit hotter than expected. CPI inflation was lower than where we were last month, but it was hotter than what economists expected. Core inflation, which is what the Federal Reserve Bank likes to look at, came in hotter than expected and hotter than last month. So inflation may be still an issue, but we'll see where that goes. Secondly, we have unemployment. And unemployment, according to the data, right? The data says the unemployment issue is getting better, that we have less people who are unemployed, that less people are filing for unemployment numbers. Now, again, we'll see how true that actually is, but this is what the data says. And so now the Federal Reserve Bank is kind of facing a little bit of a dilemma, because normally you cut interest rates when you were in a recession. Why? Because you want to stimulate the economy. I mean, we stimulated between 2019 to 2020 to keep the economy moving. We cut interest rates between 2007 and 2008. So you cut interest rates as a way to stimulate the economy. If today we are in this strong economy that every piece of economic data keeps saying that our economy is the strongest ever, why are we cutting interest rates? Because the concern is that you're cutting interest rates in a strong economy, which would cause an overheating of the economy, which would then lead to more inflationary concerns. And that's the question that I don't think anybody's gotten a strong answer on. And a lot of people have opinions. You know, people say it's political. People say it's to please Wall Street. It's to please whatever. The Federal Reserve Bank says that they want to keep the job market strong, and they feel like we can cut interest rates as a way to stimulate the economy, to make buying a home easier, to make buying a car easier. And that sounds nice. It sounds friendly. But lower interest rates have they're like a double-edged sword. And they can cut you both ways if you don't understand how lower interest rates contribute to inflation, how they contribute to the price growth of certain items. And if you are not financially educated, you might feel great because now you can finance a car at a lower interest rate, but then things keep getting more expensive. You can't buy a home, and the investors keep getting richer, and you see this wider wealth gap. The rich, the financially educated, keep becoming wealthier, and everybody else becomes poorer. And you start to see a smaller and smaller and smaller middle class. And that's what we're seeing happen right now. And most people don't understand why. But this is where, at the end of the day, you got to understand, we operate in an economy that transacts with dollars. Our dollar is what's known as a fiat currency. It's not backed by a precious metal like physical gold. We started to back away from gold in the early 1900s. FDR passed an order in 1933 to make owning gold illegal in America, as we started to move away from gold. 1971, President Richard Nixon took the dollar off of the gold standard. What does that allow us to do? It allows the Federal Reserve Bank to print more money without more collateral. The collateral is now just our GDP, our economy, which operates off of the dollar. Not to mention that our GDP, the biggest spender in our GDP is the government. 30% of our GDP, our economy, is our government spending. So let's play through this scenario right now. The Federal Reserve Bank prints dollars based off of what the government wants. The government wants to grow the economy. The government can spend more money. Well, in order to spend more money, you'd think we need more taxes, right? No, the government can spend more money without taxing people by just printing more money from the Federal Reserve Bank. So the Federal Reserve Bank prints more money, they give it to the government, or I should say they loan it to the government. The government spends the money, our economy grows, GDP grows. But more dollars are getting created. What does that cause? This is the inflationary concerns. Inflation disproportionately benefits the financially educated and the investors, but it disproportionately hurts the average person and the consumer. The average American who doesn't understand how this works is paying the price. How are you paying the price? Well, you're paying the price because your groceries are more expensive. You're paying the price because your car is more expensive. You're paying the price because housing costs are more expensive. Inflation comes from government spending through Federal Reserve Bank money printing. If the government had to spend what it earned, we would see a collapse in our economy, because that means that we lose a huge spender in our economic system. But you could start to fix some of the inflationary issues. You might see some deflation, which is good for the consumer, bad for the investor. But this is where understanding how our economic system works, going back to why it's so important to be an investor, is so important. When most people think of generational wealth, they're thinking, I own this home that's worth $600,000 with a $500,000 mortgage. Then I'm going to work to pay down my mortgage to $0. That way then I can pass down this house to my kids. But that's not what real generational wealth looks like. Real generational wealth looks more like this.